Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. This past weekend, Friday, and then over the weekend, we've had really quite a interesting situation with banking in North America, and frankly, it could have impact around the world. The Silicon Valley Bank was taken over by federal regulators in the United States on Friday, and then on Sunday, President Biden came out with some very strong comments. The banking industry in the United States took over this bank, secured depositors their money, said that investors would lose their money, and I think tried to do things to stop contagion in the industry. But I think this is a really interesting situation, and so we wanted to delve into it in far greater detail. And a VC, a venture capital expert, Richard Remillard, has joined us. He's president of Remillard Consulting. He's been in the VC business for quite a while. And he wrote a really interesting article yesterday about this topic. And so I thought we'd reach out to him and try to understand it a little bit better. Richard Remillard, welcome to the show, sir.
Well, it's great being here, Brian, and thank you very much for the invitation. Good morning, everyone. I suppose the place to start is where Brian launched his remarks. Interesting doesn't quite capture where we are right now. There's an old Chinese saying, may you live in interesting times, and it's actually a curse. Well, this is a very interesting time for everybody in the wider banking world in the United States, Canada, and in Europe and elsewhere, Israel. But it's a really, really interesting time for anybody in the startup innovation economy. So when you think of innovation, you think of companies like Microsoft, Apple, Oracle, all those household names that suggest a new technological frontier in everything from national security, artificial intelligence, robotics, clean tech. Okay, well, at the heart of that innovation economy in America and in the world is a place called Silicon Valley in Northern California, just outside of San Francisco. At the heart of the heart is was an entity up until this time last week, called Silicon Valley Bank. Well, what was it? Well, it was a bank that had 200 plus billion in assets. It had up to 50% of every innovative company and venture capital fund in the United States. Absolutely central to how we organize everything from cleaning up our environment to competing with China in the race for the future. And they experienced major difficulties last week. And within the blink of an eye, a millisecond, they went from hero to zero. And the speed with which this happened is absolutely astonishing. And the impacts immediately led to shock, disbelief, utter astonishment, and for a while, panic. And that's bad if you're in a bank. That's bad in the system. It's bad for people. Don't panic. Keep your cool. Stay frosty. And as a result, you saw the moves made by President Biden, the U.S. regulatory system, to shore things up, to reestablish stability in the American banking system. But you see comparable moves here in Canada by regulators, where the chief banking regulator has seized the activities, the assets of the branch of Silicon Valley Bank in Canada. And then over in the UK, in the United Kingdom, the UK subsidiary of Silicon Valley Bank has been sold, boom, for the price of $1.21 to another gigantic British bank, HKSB. So
$1.21.
$1.21, 1 pound. I have a pound. I could have bought it. Anyway, it's hard to overstate how significant this has been. The immediate fear and panic was by the venture capital world here in the States, elsewhere, particularly the States, about the future of funding for our innovative companies. And then the wider issue where it's morphed into right now has been, what's the impact of this going to be on the rest of the banking system and the financial, the fears for what's called financial contagion, where a run on one bank, and that's what happened with Silicon Valley Bank, a whole bunch of venture capitalists pulled their money out, for some 42 to 45 billion in nanoseconds, and that was the immediate cause. The background cause was something else. It was a rise of interest rates that we've seen here in Canada, in the States, pretty well everywhere throughout 2022. And that led to some bad business decisions, it looks like, on the part of senior management of the bank.
Your article yesterday said that 2023 is going to be an annus horribilis for the venture capital business. Do you really think?
Yeah, I think when you look at going back a little bit, 2021 was a magnificent year for venture capital across the globe. Let's call it the more developed countries, the Western industrial countries, UK, ourselves, Germany, France, Israel, and above all, America. The volumes were just, investing volumes, gigantic. The valuations of companies, what companies were worth, just soared into the heights. Returns to the industry in terms of their performance to their own investors, venture capital, similarly went through the roof. And things look really golden. Wow, this is going to go on forever and ever and ever. Well, then 2022 happened. Central banks started to raise rates. We've had 12 or 13. The Americans similarly, as inflation fears and the fears of embedding inflation finally got through to central banks, and they start to ratchet up their interest rates. And that was the background cause to the difficulties that Silicon Valley Bank found itself in. That rise in interest rates led to 2022 being, for venture capital here, the States, UK, where things move rather simultaneously and in sync with one another. That led to a not terribly good year. Definitely a downer relative to 2021, when the expectations had been for endless, seamless growth. And now here we are in 2023, and there are a number of circumstances brought forward by this totally unexpected, super rapid collapse of something that's very close to the beating heart of our innovation economy. That sent a real chill throughout the industry here, States, in many countries, because Silicon Valley Bank had expanded its operations here in Canada, in the UK, elsewhere, seeking to replicate its role as the motor, a key motor of the tech world in this age. So what we're looking at, I think, is uncertainty. Business hates uncertainty. Everybody hates uncertainty, and this might be more than the pause that refreshes, which 2022 looked like it was going to be. Just the pause that refreshes, take account of rising interest rates, wait for things to get back to normal, inflation to start going down a little bit, and it's back to the good times, let the good times roll. But that's not the case anymore. What's really interesting, I think, are two or three outcomes that I try to point to in my article. One outcome is when you look at the numbers, the data for investing by venture capital funds in Canada, and it's not hard to find. What you find is roughly 50%, about 47, 48%, depending on the quarter, but throughout 2022, roughly 50% of venture capital investing in Canada comes from ... United States, from American venture capital funds. Well, they're in a pickle right now. They needed that bailout orchestrated by the federal regulatory authorities in Washington and in California in order to simply make payroll yesterday. And the future for those venture capital funds without Silicon Valley Bank. So imagine, here you are, and your heart gets ripped out. What happens? Well, bad things happen. And that's pretty well what happened last week with the demise of Silicon Valley Bank. Sooner or later, it'll pick up. Things will return to normal, whatever normal is. But in the interim, which could be quite some time, you can likely expect quite a substantial decline in U.S. venture capital investments. So here I put my historian's hat on. And when you look back at the previous history of ups and downs in venture capital investing in Canada, the last really major down was just over 20 years ago, the so-called tech wreck, where if you had a pet rock company, you could get funding for it. Things are pretty crazy. And in that world, when things turn sour for completely different reasons than what we've seen this past weekend, American funds pulled out really fast, out the door, and went back to the States. And the industry here was, and companies looking to raise capital had a really tough time for well over a decade. So if you look at things right now, it's probably not a stretch to say that when you look at the record of the American administration, with bipartisan support, the Inflation Reduction Act, the CHIPS Act, the Infrastructure Act, all send out a message: invest in America first. And the global factors that are shaping a kind of neo-mercantilism, without getting too historian language about it, that neo-mercantilism is pushing American legislatures to favor investing in American companies, American firms. Again, remember, half of every venture capital backed company in the US, some 60,000 of them, were backed by Silicon Valley Bank, that took debt, that had equity stakes in those companies. Absolutely central. So there'll be a pullback from the States, which will reverberate onto us. So that's impact number one.
We're gonna have to come back to the other impacts,
okay,
because we're gonna need to take a break for some messages. But I think it is really quite interesting and potentially scary, because what you just described could be devastating for the venture capital industry. But if it spreads, it could be devastating for all of us.
Absolutely.
I was in a meeting just yesterday, sir, in a completely unrelated industry, with another bank that also was impacted. And someone told me in the meeting that a merger had to be canceled because the funding promise had come from another bank in the United States that was similarly caught up in the same fiasco. And so while the depositors were protected, the borrowers that were promised money were not. And so the merger was off and they had to start all over again. And I think the big fear that people have, in addition to what you've just described, is this going to impact the wider economy? And so we're going to have to take a break for some messages and come back in 2 minutes with Richard Remillard and understand a little bit better his other impacts, but also, is this going to potentially impact the balance of the economy? Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're talking about the demise of Silicon Valley Bank that occurred on Friday and then over the weekend, and then also the recovery, the saving of of the banking system, it would appear, and the protection to make sure that there's not contagion, we hope, by not only the US, but Canada, by Britain, et cetera, over the course of Sunday. Our guest tonight to understand the situation better is Richard Remillard. Richard Remillard is a president of Remillard Consulting Group, a unique Ottawa-based bilingual consulting firm specializing in providing private sector, government, and trade association clients with creative, research-grounded solutions to business issues and public policies involving the Canadian financial services industry and the venture capital business. Richard Remillard, welcome to the show. Thank you so much. I
Pleasure being here, Brian.
Was introduced to you by a friend of mine who said that you were brilliant and the best person that could possibly explain this situation to myself and to our listeners. And this article that you wrote just yesterday about 2023 being an annus horribilis for the venture capital business is really quite scary. Let me, I want to go back to your other impacts in just a minute that I cut you off from describing. But first of all, I wonder if you could take a step back and try to explain to us all what went wrong. How did this happen? I think most of us thought that, interest rate increases would potentially impact home buyers that had mortgages that were variable rate mortgages. And yet we, have seen some pressure in that in press. That people are not paying down their mortgages, and in fact, what's happening is the vast majority of their previously agreed to mortgage payment is going to just interest, and some are actually negative amortizing, such that their interest payments are now greater than the mortgage payment, and so therefore their debt is increasing. And that sort of was what people thought was going to be the negative impact of this rising interest rate environment. I don't think anyone had thought that it was going to be impacting banks, that banks would be able to pass on the vast majority of the interest rate increases to their customers. So what happened with Silicon Valley Bank? What did they do wrong?
Well, I guess I'd step back a tiny bit and say that Silicon Valley Bank had a rather unique business model. So if you look at the ultra stable Schedule I big Canadian banks, they have enormous deposit bases that are really sticky. And you put your money in, small savers, medium-sized savers, all sorts of savers, and it tends to stay there for a long time.
But Richard, let me understand. From what I understand, they had a mismatch between their deposits and the business that they were doing, and got hit with an interest rate squeeze. And then I heard a report today that they were looking for extra capital, and some of their venture capital backers in the past didn't support them. So what exactly happened?
So what happened was, again, cast your mind back to where we were in 2022 with interest rates climbing up, central banks in the States, here in Europe, trying to moderate the path of inflation by putting those interest rates up. Okay, in that, what happened was the big wider world of the macroeconomy first hit publicly traded tech companies. Their multiples, their stock prices went like this, from the top right to the bottom left. Because private companies' valuations, worth, is levered off of what happens to public companies, by and large, their valuations went down. IPOs, initial public offerings of new stocks, went down. Mergers and acquisitions went down. Everything went down. And as a result, what had happened with Silicon Valley Bank was that it had a huge amount of deposits, extra deposits, before the beginning of this crisis last week, that it had to do something with. And what it did was it put money into ultra safe, very low paying treasury securities. And then they ran into, I guess, what's called a liquidity squeeze, liquidity crunch, because their depositors, mainly venture capital funds and their portfolio companies, started to pull out deposits because things were not really as rosy in 2022 and leading up to 2023 as they had been in the prior year when they were pushing money into Silicon Valley Bank and they were taking money out. So somehow SVB had to plug the hole. And then we come into the land of management missteps, in which they try to redeem the value of some 21 billion US of their investments in ultra low yielding treasury securities. This backfired humongously. And to get to your precise question, a lot of their longtime partners in the US Silicon Valley venture world advised their clients. And again, remember, half of the venture capital backed companies in the US, some 60,000, were clients of Silicon Valley Bank, to pull their money out of the bank. And you can take a roster of premium, top flight Silicon Valley venture firms that advised their clients, their portfolio companies, to cut and run. And that's what they did. So there was an immediate outflow of between 42 and 45 billion US, like that, immediately. Out it went.
I understand more than 50 billion was withdrawn in 2 days.
Yeah, between 42 and 45 billion US. In the blink of an eye, it just went. As a result, SVB found itself in a terrible position, the terrible position that it's in right now, under receivership, management gone, prior management that had formerly been regarded as being almost like gods with a small g of venture in the US and around the world. Again, if you look for the gold standard of the venture ecosystem, and you had to point it to one place, Silicon Valley Bank was it. And in a sense, it's kind of like ripping out the heart of the innovation economy in the States, with some effects here and elsewhere. Thus, as I may have said earlier, the chief banking regulator in Canada, superintendent of financial institutions, seizing the Canadian branch, which relative to the American one is kind of small, about 400 million in loans. And the US and the UK, rather, the banking regulator there selling for a pound, $1.21.
But what I'm told is they had projected net income of $900 million this year. They had $180 billion of available liquidity. They weren't bankrupt. They were
their business was
fine. Had a cash crunch.
Yeah, well, their business was fine until you had a prime example of venture capitalists behaving badly. And if they hadn't been panicked at the least sign of risk, then the chances are SVB would still be with us and still thriving. So what it's done really is it's laid bare some of the very popular myths, preconceptions of the innovation economy, especially the venture side. Do they take risk? No, they don't. They do their best to minimize risk. And in the views of some leading lights in the US VC venture capital system, there was a risk at SVB, and they triggered that mass exodus of deposits, which was the proximate cause of the demise of the bank. I think the industry as a whole in Canada, in the States, everywhere, is going to take something of of a hit with respect to its image, the popular perception. The actions of those VCs that effectively drove a stake through the heart of SVB in a very self-serving fashion won't reflect very well on the industry as a whole. There are real-world consequences as well that are worth mentioning. A considerable number of Canadian VCs, venture capitalists, have operations in the US, invest in high-tech companies and life sciences companies in the US. And the chances are, no one really has a firm handle on it right now, even though governments are reaching out to everybody in the industry, both tech and investing, to get a handle on just what the exposure is. But there's a number that will be impacted despite the "don't worry, be happy" comments made by new management in SVB. A former Fannie Mae CEO who was brought in by the chief regulator to run the company, and who said, "Don't worry, be happy, everything's all right, things will continue as they have been." But I think that there's a fair chance of that getting discounted. So you wonder about the extent to which Canadian VC funds have exposure in the States to SVB and its operations on all levels of the business. And then if you look at Canada, which is a fairly smallish SVB operation, what's going to happen to the remnant that the Office of the Superintendent of Financial Institutions, Chief Banking Regulator, has seized and is proposing to wind down? That loan book of approximately $400 million could be sold off loan by loan by loan by loan, or it could be picked up by one other player in the industry, likely Canadian, likely one of the bigger banks. But it's hard to say. One of the, I think, issues is, and you see the beginnings of this, established players might be looking for indemnities in the event that they take over some or all the aspects of SVB's operations, so they don't incur legal liabilities that would predate their takeover of those operations. But the chances are, what we'll see in Canada is one of the larger players taking over those operations, which are small from a balance sheet perspective of, let's say, any of the big banks, any of the big six Schedule I Canadian chartered banks, and then integrating it into its operations. So it means less choice. It will mean less choice for small businesses, for innovative businesses. And there's a concern that one of the reasons for the stunning success and ongoing success of SVB was its recognition of how to make loans to companies that are early stage, that are high tech, that are not cash flow positive, where they might have a fair amount of intellectual property crystallized in patents and the like, and how to lend against that. And other financial players, with the exception of one or two smaller ones, don't really have that same niche expertise, which was such a strength for such a long period of time for SVB. So we might face a situation where the innovation economy in Canada becomes more conservative, driven by more conservative lending operations of what had been formerly SVB.
So I think this is a real issue here. You know, we talked about the deposits, and it sounds like different regulators are securing the the deposits and the depositors. We've talked about the investors and the note holders, and it sounds like they're going to incur a massive loss, if not a complete loss, depending on whether people are willing to buy the loan book, as you've indicated. But the more important thing is this role that SVB played in the innovation ecosystem. And I understand that it was like the nucleus, the fulcrum, the main point where hundreds of different venture capital firms really look to for development of their businesses and loans that would get them going. And it's been described as one of the main places where angel investors and VCs and entrepreneurs really cross-pollinated, cross-fertilized with each other. And the word that was described by one of the executives is that Silicon Valley Bank extended the runway for VCs to get capital to innovative opportunities, and they became really a local legend in Silicon Valley, where everyone wanted to be a player with Silicon Valley Bank, wanted to raise a loan, wanted to put their bank accounts there, wanted to leave some money there, etc., because they wanted to be part of the ecosystem. And
well, that's entirely correct.
They were the only bank, from what I understand, doing that business. So
yeah, there are a couple of
smaller
ones, much smaller ones. But extend the runway is really, for an entrepreneur, there are always trade-offs in raising capital. And one of the signature developments in the last number of years has been the invention of venture debt. And if your company has taken on venture debt, you can extend your runway, your cash burn until you need to raise more capital, and you don't have to issue dilutive equity capital to others to get that runway. So that was a key role, absolutely key role played by SVB. It also had direct investments in companies. A bunch here in Canada, scads and scads and scads in the US and the UK, and Israel too, I think, although I'd have to check that. And it was a direct player. So if you look at two aspects of the business, there's a sheer volume of business that they did with literally everybody in Silicon Valley and in that ecosystem. And then you look, which was enormous and dominant. And then you look at what its image represented. So when you think of innovation, you think of America, you think of, hey, iPhones. You think of putting a man on the moon. Well, basically, you're looking at Silicon Valley. And for a company that has had Silicon Valley in its name, the brand value of that name, above and beyond all its business operations, from loans to equity stakes in high-tech and life sciences companies, is almost incalculable. It's like trying to put a value on the Sistine Chapel. It's hard as heck to do. And that's what we're dealing with. If this had been ABC Bank of Tulsa, not to offend friends in Tulsa, ABC Bank of Tulsa, yeah, that brand value might not have been quite as strong. But being in the heart of the global innovation ecosystem, with the name firmly branded there for all to see, suggested North American global dominance in this part of the economy. For a long time, I think venture capital has been kind of insulated from the vicissitudes of what takes place in the wider world. But I think that era has come to a crashing, shuddering stop today. And that wider world, that geopolitical world, has become a primary driver of what takes place in venture capital, both here and elsewhere.
I think the issue is there a risk of contagion? And so we're going to take a break for some messages, and we're going to come back in just 2 minutes with Richard Remillard and talk about, could this be wider? Could this have a bigger impact? Back in 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're talking about Silicon Valley Bank. Its bankruptcy over the course of Friday and the weekend, and it's the save of all of its deposits and depositors by regulators in Canada and the United States on Sunday. And we've been chatting with Richard Remillard, who is a president of Remillard Consulting Group, a unique Ottawa-based bilingual consulting firm specializing in providing private sector, government, and trade association clients with creative research-grounded solutions to business issues and public policies involving the Canadian financial services industry and the Canadian venture capital industry. And Richard was recommended to me by a very astute businessman who said the most knowledgeable man in the venture capital business in all of Canada, particularly in regards to financing of it, is Richard Remillard. So I really appreciate you making yourself available. Richard, I've read your article that you posted yesterday about 2023 being an annibus horribilis for the venture capital business, and we've talked a little bit about that so far. But I think another one of the big questions that people have is this could this be the start of some contagion for the balance of the financial services industry? My understanding of what ended up triggering the demise of Silicon Valley Bank is that they just didn't have the appropriate interest rate hedges. So it wasn't necessarily something about the VC industry that killed them. It was that they didn't have appropriate interest rate hedges in place, given what's happened with the interest rate increases that the US and Canada and people worldwide have instituted. And who was to know that this one bank didn't have the appropriate interest rate hedges? Who's to know that other banks don't have it? And there's been a couple of other few fatalities over the course of the last couple of days. What's your sense? Is this the canary in the coal mine? Is this the start of something bigger, or is this just an isolated incident?
I think part of what happens will depend on a number of factors. Factor number one is how speedily the as yet uncertain future of the rump of SVB, which is the main part of the bank, how speedily its fate is determined. If it gets subsumed under a much larger, more stable, strong capital and liquidity ratio bank from the money center of New York, JP Morgan Chase, Citi, Bank of America, maybe a few others. If that is speedily resolved, then everybody can take a Valium. But if things drag out, then the fear to which the financial sector is prone when it's not chasing greed will take hold. So that's number one. Number two, in the interim management of SVB has committed to, at least verbally, to business as usual, making loans, facilitating payroll, and all the rest. If that's the case, and there isn't an operational hiccup, a major operational hiccup, then things will stabilize. Thirdly is, and you see the reaction in markets yesterday, there's a growing divergence between the performance of stock performance of the majors, the largest banks, and the smallest ones. The smallest ones are likely most at risk, I would say. The largest ones less at risk. And in fact, there's even been an uptick in their stock prices today, both in Canada and the States. But we're not out of the woods yet. Already, there are all sorts of issues separating out the larger banks from the smaller banks in the States. And under conditions of extreme nervousness, there is a flight to safety, flight to quality, and generally that favors larger institutions than smaller institutions. So we're probably looking at some consolidation, further consolidation in the US banking system, less so here, I would think. Lastly, I think, to answer your question, is regulators are looking really carefully at a host of issues that have been raised by this sudden explosion of SVB. And these range in the States from amendments to the Dodd-Frank's reform bill following the financial meltdown of 2008, a global financial crisis. The last time major bank, Washington Mutual, bit the dust, and where there have been amendments made to Dodd-Frank. That was a bill introduced to strengthen the regulatory oversight, capital liquidity ratios of U.S. banks. And so there's an issue here about how, in a divided Congress, how fast further improvements in light of SFB can take place. And there's a great deal of attention that is about to be focused on what to do with those securities that haven't had to be marked to market, but are on bank balance sheets, and which contributed to the unfortunate demise of SVB when they were marked to market, sold at a discount by SVB, and then the cascading problems took place really quickly. Several factors.
You mentioned that private companies follow the public company multiples and the public company valuations, but I think there's a lot of private companies that haven't been marked to market the way that you just described that they should be, whether they're loans and would logically be, but a lot of companies that haven't. One of the criticism in the real estate industry is that a lot of real estate and REITs haven't been marked to market as of yet, and that the vendors are still and the owners are still living in a world of 6 to 9 months ago when cap rates were 200 basis points lower. So I come back to my overall question: what's the chance, do you think, that this is just the start of a bigger financial collapse, or no, that regulators have moved in so quickly and dealt with it so fast and so definitively that this is going to be an isolated incident? And the big question is, is this 2008 all over again? Is this Lehman Brothers? And are we going to see this spread?
Okay. Let me deal with your first point, and then the second and larger point. First point is mark to market. Well, there is a lag because how do you value a privately held company? They're not public. I mean, one of the joys of public listings is you get price discovery on what a security is worth, because you've got a market. It's a public market. There are indicators, there are rules and regulations for disclosure of financial information and all the rest. But in the private market, it's private deal between investors and the portfolio company. So there are different metrics used, but by and large, the public market multiples drive at some point in time, with a several month delay, the valuations in privately held companies. So I think the expectation in many people was that, at least in venture land, was that 2023, first half of 2023, we start to see those valuations come down smartly and follow the public market tech sector valuations. Now, your question about are we back in 2008? My sense is no. And I guess it's a qualified no. It's a no, I'll come to reasons for that. It's a no because the system as a whole, international and national, is a lot stronger than it had been. Capital ratios, liquidity ratios are much tighter than they had been in 2008. Regulators are much more active and overseeing than they had been. I'll give you an example. There are media reports that the Superintendent of Financial Institutions, who's the prime bank regulator, has requested liquidity data and other financial data from our Canadian banks on a daily basis. And that says to me, we've got a regulator who's not asleep at the switch, who's active and won't be caught short.
Okay, Richard.
Qualified, yes.
I hope.
Qualified. So here's the qualifier. The qualifier is that you never know what type of mess is hiding under a rock, and until you lift the rock and it becomes obvious. The big systemically important banks in Canada, the one here in the U.S., one in Canada is Royal Bank. There are very complex, huge, gigantic machines, and you assume that there are adequate internal and external risk controls. At one point in my life, I was on the board of a small federally regulated trust company, and the hoops that we had to go through in order to get anything new across were just daunting, absolutely daunting. And take that and times it by 1,000 times, and you've got one of the major banks. But that being the case, mistakes are made. Things can get overlooked, but it doesn't, at least today, not so much yesterday morning, or at least Sunday night. Today, it doesn't smell like 2008, and the panic appears to have subsided. You look for things like transmission risk between SVB and maybe some of the smaller Western regional entities, but that transmission risk to the larger entities is not all that great, at least from an outsider. So qualified, yes.
So I hope you're right, and you probably are. That said, in 2008, 2009, central banks, their biggest vehicle to saving the financial sector and then the economy generally was by lowering interest rates to 40, 50-year low interest rates. Today, we don't have that ability because inflation is so high, and they're increasing interest rates and keeping them high to stem inflation. So hasn't the most powerful armament that central banks have to save us from a financial collapse and financial contagion been taken away right now.
Well, it's interesting. You could argue that for banks with more stable deposit rates, rising interest rates is beneficial to their net interest margins, and it was management goof ups at SVB and the unique nature of their concentration in the tech industry and life sciences that brought them to grief. Concerning central banks, it looks like we might be on the cusp of a very delicate point. And the delicate point is to the extent that, and I'm talking here mainly about the US Federal Reserve Bank, which is very hawkish with respect to inflation, where the inflation numbers latest came in at 6% annually once the January and February numbers are put in. High, well higher, 3 times higher than the 2% target that central banks have taken as their guidepost for the last number of years. And getting down to 2%, if that remains the target, and on which a fair amount of central bank credibility remains, is going to should take higher interest rates than we see right now. But the obverse of that is those higher interest rates in the current environment might not be particularly beneficial to the weakest entities in the banking system. Not the strongest, but the weakest entities in the banking system. So what do you want to do? Save the banking system or slay inflation? Take your pick. And it's a Hobson's choice. Neither one very good. So that would argue in favor when you're confronted with making a decision between a rock and a hard place, you do nothing. So speculation went up considerably over the weekend that the next move of the US Federal Reserve would be no move, just to hold rates steady despite expectations the day before having been majority for a rise in interest rates.
Well, and the majority had increased in expectations of a rise in interest rates, and the expectation had gone from 25 basis points to 50 basis points. And so people thought that the Fed would become even more hawkish.
That's right.
Given that the job market, the job employment numbers were so positive, and the economy was is still on fire, and so it is a challenging situation that the Fed and the government. But I come back to, I worry, given that interest rates are so high, and they probably should go higher, and they may not increase it the way that you're arguing, but that the way to save the banking system in the past has been, and the economy has been, to lower interest rates, which you can't do. And then, the way that typically governments deal with recessions, which is the logical outcome of where we are right now with the high interest rates, is to spend more money and have fiscal stimulus. And governments don't have that latitude. We got the highest debt to GDP that we've ever had, given the spending of COVID. So,
at least in Canada, the federal government, which tables a budget on March 28th, has been sending out, some would argue maybe mixed messages, but by and large messages of restraint and don't expect us to spend like the proverbial drunken sailors. And we'll see. And
yet at the same time, you hear comment after comment about all of the subsidies that industry in the United States is getting from the Inflation Reduction Act, from the CHIP Act, from all the onshoring, friendshoring, et cetera, that you've been talking about earlier and that other people have been talking about. How can you not spend comparable kinds of money, maybe on a per capita basis, but still comparable kinds of money? Because otherwise, all of this manufacturing is going to go whoosh down to the United States, and the manufacturing.
I think there are three fiscal drivers to watch, and I say this as an ex-finance staffer. Number one, there's that great big sucking sound from the U.S. that's in the Inflation Reduction Act, the CHIPS Act, and the Infrastructure Act.
where we just might see a huge amount of activity heading south of the border because of the richness of the incentives. Number two, there's health. And as a subset of health, of course, what you see is pressure from the government's coalition partner to establish a fulsome dental care plan and then launch pharmacare. And so there's spending pressures there hugely. And then thirdly, because we're living in a really dangerous geopolitical world, just look around you. We've never met as a country that 2% of GDP target spend for defense. And all you have to do is talk to anybody in the defense world. They're crying for materiel, especially since so much has been sent to Ukraine in the last 11, 12 months of the Ukraine war. And a refresh of massive amounts of equipment is required. And it don't come cheap, as they say. So there are three macro pressures that are out there with respect to our response to the IRA, the Inflation Reduction Act. Minister of Finance announced something called the Canadian Business Growth Fund to be capitalized at $15 billion, and she's been taken to task by parliamentary committees, particularly in the Senate, for not having any details. But that $15 billion, as far as I can determine, is a mix of public and private monies, using the old 3-to-1 formula, where they expect $3 of private money from private financial institutions and funders for every dollar of public money. And we'll see what this is key when looking at what looks like on the surface a big $15 billion spend, what their assumptions are behind getting that 3-for-1 ratio, which is a favorite ratio for other programs of the government of Canada, and then what the time horizon for that fund actually is. 15 billion over 1 year is pretty rapid. Over 15, 20 years, doesn't look so heroic.
Well, and I'm going to add two more to your three, if I could. I think that the fourth is just healthcare demands, whether they come from the provinces that are demanding more and more monies. We've already agreed to give them more. The federal government has, and still the provincial governments are demanding more. And I've interviewed numerous people over the course of the last little while that have called the aging of the baby boom the coming tsunami in needs for long-term care, home care, institutions, et cetera. And clearly, some of the risks there were laid bare during COVID-19, where we were unprepared. And the biggest tragedy I think of COVID-19 was deaths in long-term care. And so clearly we've got to do a better job in that area. And money is going to be one of the things. And then I think the fourth or the fifth, I apologize, is all of that's crowded out by higher interest rates that are unquestionably increasing the interest bill that the federal government has to pay. And so when you limit the flexibility because of the higher interest rates, which you're putting in place because of inflation that you're trying to beat down, you restrict how much money is left over for all these other things, and all these other things, as you correctly pointed out, are growing. So we've got a pretty challenging fiscal situation. But I think
that there's no doubt.
But I
no
think
doubt at all.
I think that if this isn't the contagion that I worry it is, and you've convinced me it's not, I think it may be the canary in the coal mine that says there may be a coming contagion at some point in time in the future. And so therefore regulators and banks and federal banks and governments need to strongly consider what they're doing. And probably one of the big negatives is that because we got inflation expectations completely wrong, and we therefore combated it with interest rate increases, and they were the fastest interest rate increases in history. We may have got inflation wrong. We may have got the interest rate increases wrong, and people weren't able to adapt as quickly as they could have and should have. Didn't have those interest rate hedges. I think we've got more variable rate mortgages in Canada than we've ever had, and so therefore individuals are really at risk. And so I really worry that we've got a coming problem, and it may not be right now, and it may not be the contagion caused by Silicon Valley Bank, but I do think that this may be the canary that we've all got to pay a little more attention to. Anyway, Richard Remillard, thank you so much.
Well, it's a pleasure, Brian. Absolute pleasure discussing these important and a little bit frightening issues with you.
I look forward to having you back sometime. That's our show for today, everybody.
To.
Thanks for joining us. I remind you, I'm on every evening, Monday through Friday at 6 p.m. You can stream me online. You can get me at 9:60 a.m. in Toronto, and you can stream me online even from Ottawa, sir, at www.saga960am.ca. Good night.